It looks like we're heading towards a landslide Labour victory. So what does that mean for you, and most importantly, for your tax bill? In this video, I'm going to guide you through what we can infer about what taxes Labour will most likely be putting up. It's unlikely that Labour will give much notice on any of these tax rises, so it's important to be well prepared and aware. Hi, I'm Raji. I've got an economics degree from the London School of Economics and have spent the last 10 years working in finance, investments and small businesses. So let's get to it. Keir Starmer has gone on record to say he will not increase income tax, national insurance, VAT, corporation tax and council tax. Yet Labour plan to raise over 60 billion from taxes. So what does that leave? Capital gains tax is a key tax that we're likely to see go up. You pay capital gains tax on the sale of any assets. That could be a second home, a business, investments in the stock market, or dividend income. Most small business owners pay themselves a low salary and then take out dividends at the end of the year at a lower tax rate. The highest tax rate for dividends is 28%. Labour are also likely to introduce some parity between income tax and capital gains tax to prevent asset owners effectively paying less tax. An example of this is in the private equity industry, where currently fund managers pay a flat rate of corporation tax on any of their gains or effective carry in the fund. This carry is taxed at 28%, yet Labour had been on record in the past to say that they will increase this to the highest rate of income tax, which is 45%. This could largely impact the financial industry, with finance working professionals in private equity simply picking up and moving to other countries. If the personal capital gains tax rises, this is likely to come into play without any warning to prevent people selling their assets or houses before these changes come into effect. Pensions and inheritance tax. The boomers have a huge amount of money locked up in their pensions, and this is something that Labour are most likely going to raid in order to redistribute wealth and reduce the fiscal deficit. Pensioners are currently allowed to take up to 25% of their pension pot tax-free, whilst they are able to pass on any remainder of their pension pot to their children inheritance tax-free. These two policies could change. In fact, Rishi Sunak made a big point of it in his campaign to go out and state that the Conservative Party would not be making any changes to pensioners or the way that pensions are treated in terms of tax, hence suggesting this is something that Labour does have in store. That on private school fees. This is a policy that Labour have made clear that they will be implementing. Currently, schooling comes under a special exemption from VAT. However, this will be changing, and school fees will see an additional 20% VAT applied. This means for a family sending 2 children to private school at a cost of £15,000 per year per child, this will then increase to that £30,000 being £1,000 per year, making this highly unviable for the majority of working professionals. Housing related taxes, namely stamp duty and council tax. Whilst Labour have said that they will not be putting up council taxes, when asked directly if they will be changing the council tax banding, they have not given a clear answer, suggesting that this is something likely to change. The focus of this change will likely be related to the value of your home, with higher value homes seeing an additional council tax liability. Stamp duty is something that we can also see rising on secondary home purchases. Currently, additional stamp duty for homes after your second home sits at 3%, additional to the current banding. This could be something that we see go up. Tied to this is Labour's announcement that they will be increasing tenants' rights and limit any evictions without cause. This really showcases that Labour want to put a bit more power into tenants' hands and tax asset owners' homes higher. And finally, tax wrappers. Labour have made it very clear that they do not wish to increase taxes on working people, yet their definition of working people include anyone who cannot effectively write themselves a check, which suggests people who do not have significant savings. If savers are to be taxed, we're likely going to see this with the removal of some tax wrappers, or at least the reduction of some of these wrappers. These could include ISAs. The current ISA allowance is £20,000 per year without a cap. We could see a cap of, say, £100,000 in ISA wrapped savings implemented. We could also see a wrapper reduction in terms of venture capital trusts or EIS, enterprise investment schemes, which allow investors to invest in startups in a tax efficient way. So there you have it, 5 ways in which Labour could be putting up taxes, but we need to wait to see what they actually implement if and when they get into power. If you like this video, please do like and comment below, share your perspective, and do please follow for more videos.